So today's video will be discussing the near-term setup on the Nifty and key indices, what is happening in the Nasdaq. These were interesting observations from overnight. And I'll also touch upon an interesting subject some of you may have been reading and trying to understand the yield curve, but there's also why it is steepening and why it is different in the form of what it is doing right now, which leads to some additional terminologies which I will try and explain. So it should be slightly educative as well. I've been paying attention to that as one of the important or interesting tools that is telling us that we need to keep an eye on the changing momentum in the market on multiple time frames that will happen. Today is the last day of the month, so we will get additional signals also from different indices. Now, we've also done this very detailed long shot webinar. If you haven't watched it, it's on Indiacharts Insiders, 3.5 hour long. So that's a much more detailed discussion on the whole market. Here I'll get into some of the near-term setup, some of the observations, and like I said, the yield curve. So let's get right into that. Now, sometime back, I had published a chart of the Nasdaq on Twitter, and I got some comments both ways, and the chart was showing this falling trend line being touched a third time over here. And then I said when it falls off a third time, the chances are it could break the lower line, which is this red line over here. I've also drawn a parallel channel line because that sometimes acts as a near-term support, and you can see it just touched that and bounced off in the last 2 days. Now let's get to the near-term setup. So one thing which is happening is after 3 tops on the upside, the risk of breaking the downside becomes high. Similarly, if we didn't break 3 bottoms on the downside, we could have said the opposite as well. So this is what we are seeing now. To just give you a more near-term example of another index that did something like this, not from a top, but from somewhere in between, and I was actually trying to anticipate whether the Russell 2000, which is the US small cap index, after this very sharp decline, is this triangular formation a basing formation? Because sometimes you do get a big bear market, ends with a triangle, and then things reverse. But here you had the situation where you had 3 tops, one after the other. So when this third top was occurring, I was trying to think, okay, are these 3 bottoms here? And is this last one a truncation? So we try to think about it both ways. Okay. And I'm happy to change my view at the right time so that, there's enough. So people don't understand this. So I'll just highlight it. That when we are down here, I was already saying the Russell is bottomed out, and the possibility that if these are 3 bottoms, will we break out on the upside? So it's important to take that kind of a view here when it is happening rather than when it is breaking out. I never wait for a breakout. Most breakouts fail, or even if they are going to succeed, you're often late. By the time the breakout happens and everybody knows, the market turns the other way, and that is why it's a slightly dangerous thing, and that is why we use Elliott wave analysis, which can get us slightly ahead of the trend. So when Elliott wave says that this can be a potential E, right or wrong is, we come to only later on. We took that stance and it did rally. So that gives us enough room, for you to change. Now, the opposite happened at the top, that you got a third time failure. So when you get a third time failure, it again gives you the same signal on the opposite side that if you're failing a third time on the upper line, then are you going to break the lower line? So once again, it twists on its head the opposite way, and then we start wondering, okay, is this E? So I'm okay with taking this as an alternate, then saying, okay, fine, this is wrong, but at least I took that view at the right time where the risk reward was favorable for a trade, even if it didn't convert into an investment. And then when it turns here, you can actually reverse without losing too much. And now the same thing from the top, turn early so that you don't have to really be struggling when this is happening, because when this breakdown happens and then it bounces for even 2-3 days, we start getting worried. What has followed here in the Russell though is after this initial pullback test of the breakdown, it has actually continued lower. And so we're continuing to track this in terms of where it will go. Now that the triangle has formed, it's most probably some kind of an X wave, and we're in the next leg down, which could very well be a Y, and have a long way to go. That doesn't mean you can't get oversold bounces in between, but as you're seeing, so far there is no sign of that happening. So you have to just trail. That is the only thing that works. So which takes us back to the Nasdaq example, where we have marginally just broken the lower line, taken support on the parallel line. Now this bounce is happening. Okay, so I am still thinking just like in the Russell, this may be just your minor bounce, because note, I've also marked this as 1, 2, 3, 4, 5. Now what does that mean? For those who are not familiar with wave analysis, whenever we mark 5 waves in any direction, whether it's up or down, it's indicative that that is the trend. Whichever side 5 waves form, that is the trend, and everything against it is counter trend till you get 5 waves in the opposite direction. Okay, so that is a very simplistic explanation of wave analysis. But it helps even in knowing that simple bit. So if I can see that, okay, this is 1, 2, 3, 4 and 5, that means I'm going to get a bounce, and after the bounce it's going to fall again, because 5 down means the larger trend is down and every bounce is a counter trend. So is that counter trend going to be small? Then it's already done yesterday. We have had 2 days of bounce back. It's sort of hitting the 40-hour average here. If it doesn't cross this and breaks maybe this previous swing low, you can rest assured I would start thinking that another 5 wave down is going to start. The second alternate is that somehow it gets above this level, in which case the bounce gets a little bigger, comes back to the previous 4th range and then goes down again. So this is something I just wrote about this morning on the Indiacharts Insiders posts, which you also get on the Indiacharts app. If you have not used it, you can download and start using it. At least see the free posts, so that will actually get you in line with the kind of analysis we do. Now let me apply the same thought process to the Nifty. Okay, so while this is happening, we are seeing that the Nasdaq should break down, but question is from here, or will it bounce a little more? So we need that additional confirmation maybe from tonight's market action in the US. But in India, we're already getting that kind of market action. Let's see how it plays out at the end of the day. We do have a 5-wave fall here, as I've marked, and I've marked this as either C or C1. Now what that really means is that the top that we made here, 20,222, from here we've done wave A, we've done wave B, and now we are inside C. Now either C can be complete, we can say ABC is done, we're going to get a bigger X wave, retracement of this whole thing, then you go back to 19,700 or something. But the second alternate to this happening is that what if wave C extends? And that's something we don't know immediately. Okay, if it extends, then you're just going to get C2, which is a second wave pullback. Again, the same way like the Nasdaq, it may come very close to the 4th wave of the fall, which it has already done. Somehow this is coinciding with the 40-hour average here. So this is close to around 19,180. I've been mentioning the level 19,200 broadly speaking, that if you don't cross 19,200 and this remains a 3-wave bounce, then I'll have to consider it as C1, C2 and then C3 down. Okay, if it somehow manages to save this end of the day today, then we have a chance that this is a larger retracement of this fall before we fall again. So these are the two alternates very near term for Nifty. Okay, and this is how we are going to continue to map it in the form of either ABC, C1, C2 or ABCX, ABCX. Those are two very, very technical, I know. But broadly, I hope you understood the 5-wave theorem that something falls in 5 waves, we look for a 3-wave pullback. And if you get a 3-wave pullback, we expect another 5 waves down. That is sort of the simple theorem. And if you can identify those 5s and 3s, you can sort of tell which way we are headed. So what happened today morning is Nifty opened with a gap up. At least the opening quote appears very high, probably because the Dow was up some 500 points. But in general, there was some pressure at higher levels on US equities. When you look at US indices across the board, not all of them were exactly rocking. So if I go to this US indices list, which you see here on investing, which I actually use, let me see, yeah, I can expand it. So you can see the whole screen. So when you look at this, you had the bank index up a bit. Some of them gained momentum, but in the night, some were even down intraday. Some picked up later on. You saw the automobiles index break the previous low. Now it is looking like a 345. So I was waiting for this 5th. Now when this 5th happens, yes, we can say that we are getting into C over here. And so that means, okay, should the auto index also complete a 5-wave decline and give you a bounce? Or is this fall going to be 5? Is this going to be a larger A, B and then 5C? Then it won't go beyond this 4th wave high. Those are things we'll watch and decide. But yes, once you reach a 5-wave decline, you are looking for some kind of a pullback, with the best case scenario being back to the 4th wave from where it fell, which is close to around 904 on the automobile index. So we have a couple of such settings where we are trying to judge, is this Russell fall a 5-wave? Are we in the 5th? Or inside the 5th also, I feel there's still something left. So it may be, if I say that this is the 4th wave high, it may be 1, 2, 3. There's a 4th and a 5th left before it's done. So there's some intermarket variations in terms of the wave count. Something is completing 5, something still has a 5th left. But once we do that, are we going to get some kind of a pullback or a retracement? And in the meantime, what will India do? And then remember, this is the Fed meet week. So there's going to be some volatility around that. What they do, expectation is that they'll leave the rate same and they'll keep the possibility of one more hike in future on the table, just like they did in the last meet. In other words, it's just going to be a repeat of the last meeting, status quo. But for the market, if it means that rates remain higher for longer and they're nowhere close to changing their policy stance, that's a risk that valuations will continue to unwind on the way down. And that is why I'm looking for this 5-wave fall bounce and another 5-wave decline setup, because that's what it really means. Can we get significant bounces here on the Russell? I'm trying to think, okay, is it doing 5? Will it be an A? Or will we just keep extending from 5 to 9 to 13, whatever? We don't know that, but we'll have to be careful because the environment around interest rates is starting to raise recession risks. And this brings me to the central part of the topic, and I said I'll explain the yield curve aspect of it as well. So let me just load that chart so that you can actually get a good sense of it. And then I'll explain for those of you who are new to this concept. Some of you know, already reading a lot of macro. Some people still don't get macro and they just feel that it's above their head to really spend time trying to understand it. But this is what it is. So there you are now. It's on my screen. The bottom end is the S&P 500. The top end is the yield curve. Now, what is this yield curve? I've seen a couple of different hedge funds measure it in different ways. The most popular, which we've all heard about for more than 2 decades, is the 10 to 2 spread. 10 to 2 spread means the 10-year bond yield minus the 2-year bond yield. Now, some funds may use a 10 and 3. Some are even talking about 10 and 3 month. It's all fine. It comes to the same conclusion and same factorization. The reason they use different ones is just to eliminate any false signals and have a 100% strike rate, because this has been one leading indicator that economists have all glued onto, because historically it's had a 100% strike rate so far in predicting that bad word. The bad word is recession for the US. Okay, so since it's had such a good strike rate, this is what people end up looking at. So now let's just get down to some basic understanding of what this is. So I'm just going to take a plain white screen, dabble a little bit so that those of you who don't understand it, let's just put it down. What are we trying to understand? We're trying to understand the yield curve, right? So what is this yield curve? The yield curve essentially is when we take the 10-year interest rates, right? The US 10-year interest rates, which means what interest are you going to get from a government bond if you hold on to it for 10 years. So we call that the 10-year bond yield. Okay, and if you want to look on that on TradingView, all you have to do is US 10Y. Okay, so you see this over here, the US 10Y, the US 2Y. So it is a difference we are trying to take. This is 4.8%, this is 5%. So there's a 0.2 kind of difference, like a 20 basis points difference. Okay, but this has varied. It had gone all the way to 114, 15 basis points at some point of time. So that's more than a percentage difference. Let's see what that really means, okay, for us. So when we are looking at the 10-year bond yield, okay, for the US, so we call that the US 10-year. Let's say it is at around 5.02 as we just saw on the screen, right? No, in fact, it's the 2-year that's at 5.03. Okay, so the 10-year is actually at 4.88, and then we take the 2-year yield, right? So we take the 2-year bond yield, which is at 5.03, and we are trying to plot the difference between the two. Now you'll find something unusual. The short term, which is 2 years, okay, actually has a higher interest rate than the 10-year. Now, isn't that unusual? I mean, if you put your money in the bank for 10 years, would your fixed deposit give you more money than if you just put it for 3 months? The answer is you'd get more for 10 years than 3 months, right? Or more for 1 year than 3 months. So why is it that the long-term rate is getting a lower yield than the short-term rate? And this is what we call as a yield curve inversion. So when we plot this difference between the 10 and 2, typically it should be positive, where the long-term is greater than this, because if you minus the 2, you should get a positive number. So now you go back and look at this. The upper part of this chart, along with the S&P 500, is plotting what we are calling the yield curve, and it's basically going above and below zero. This line here, right in between, this horizontal line in red, is the point of 0. Okay. So if it's above 0, which is most of the time, as you can see, the long-term rates are always above the short-term rates. But there's a short period of time when that changes. Why does that happen? Here's the simple answer, or maybe the correct answer. When the economy is doing very well, and as time goes, so let's presume that a lot of time is, passing us by. And as that time is passing us by, we are trying to think about, as that time passes us by, economy is heating, overheating. And as it overheats, what do people do? They buy more stocks. And some of the people buying stocks are doing an asset allocation, which means they're selling bonds and buying stocks. So when they're selling bonds, and especially they're selling their long-term bonds, the long-term bond yields, they start rising. But they also start selling their short-term bonds. They say, why should I put my money in short-term treasuries? So they end up selling a lot more short-term bonds and putting it into stocks because the short-term return in stocks is very, very high. And so the first thing that they end up doing is selling the short-term bonds, money market, securities and so on. So money market funds, which may be investing in the short-term bonds, get closed out. All the money moves into equity. When that happens, the 2-year yield actually starts shooting up very, very fast, at a faster rate than the 10-year. So the 10-year is going up because the Fed is raising rates. So the market is getting overheated. Let's raise rates. But the 2-year is going up even faster than the Fed is raising rates because people are selling their bonds and buying stocks. Okay, so this is now the answer. So when they're selling their bonds, the short-term bond yield is shooting up faster than the Fed is able to raise rates. That causes the yield curve to invert. It goes upside down, wherein the difference becomes negative. Okay, so we call that the inverted yield curve. And here's the thing with the inverted yield curve is that when economists started to look at it, they started to look at it and predict that, when it's gotten so overheated, then possibly this inversion is a sign that a recession is coming. And it's just history. History was showing that there was always an inversion before a recession. So it became a predictor, and this prediction meant that somewhere down the line, which means 6 to 12 months, sometimes even we've seen 2 years, after an inversion, you may end up hitting a recession. So you see, you got the first inversion over here in the yield curve, and then it bounced around a bit. So if you take this point over here, it's somewhere down here, where the housing market also, you have got the subprime casualties back here actually. For those of you who think it happened after the top, it didn't. The subprime crisis was already announced back here. I was in the US in, May of 2007. My brother was showing me around, these houses just lying around, it's okay. It's not affecting anything. It's just some people have left it around and moved on because they bought too much. There's no impact on the economy. So that only happens much, much later. The market still went higher. Okay. And 6-8 months, 1 year down the line, the yield curve, instead of remaining inverted, again started to go up. So that is what is called as the steepening of the yield curve. Okay. So this is the flattening, the inversion, and then it's the steepening. The steepening, interestingly, is the point after which you get first the stock market crash, right? It starts to fall. And then second, the data around the economy gets bad enough for the MBA, which is the US institution that will officially announce, yes, we are in recession. And then they will also say, we were in recession since this date, which is much before the date they accept it's a recession. And then we say, after this inversion, this is the entire period during which we were in recession. Okay. So all these recessions have happened after the steepening. And so but the stock market has started to fall exactly when the steepening starts, because that's when the stock market and the bond market start recognizing that things have gone too far and it's about time. So what has happened in the current scenario? This is the last inversion. It was very, very temporary. Interestingly, the market went up a bit and then collapsed, and that was COVID. So it's often COVID in hindsight is seen as a very short event because you got this yield curve spike, steepening, which didn't last. It didn't last till the previous cycles, it didn't go all the way back up there. And then you inverted again. And moment it inverted, from last year, people have been screaming recession. But the market was not ready, So this is why we pay attention to market technicals and sentiment, because if the market is not ready, it's not ready. You don't want to call a recession early. So from Jan of last year, I was saying if it takes 6-8 months for the market to go down, then markets will go up, and that's what they have done. But now, what is happening? The yield curve is starting to steepen. It's starting to go up. It hasn't crossed the zero line. And moment it starts going up, what's happening to the stock market? It's starting to go down. So basically, the stock market now is starting to price in the possibility of a recession. So this is the short term of it. I've zoomed in. This is the breakout in the yield curve. This is the stock market breaking its rising trend line from October of last year to the March bottom. That line is broken for the S&P 500, and which is why I am now concerned that the market is starting to recognize the possibility. The US market is starting to recognize the possibility of a recession. Now here's one big difference in this whole story, and here you're going to learn two more terminologies. Okay, this steepening of the yield curve is now being called as a bear steepening. Now, and the last two were actually bull steepenings. Now, what is this bull steepening, bear steepening? It's really got to do with what the bond market is doing right now. So you see, what happened in the last two occasions is that when there's a recession, the opposite activity starts to happen. I mentioned some time back that, when things are booming, people sell their short-term bonds and they buy stocks, and so the short-term bond yield shoots up. But the moment they start sensing, well, this is done, it's overheated, the stock market is going to fall, what do? Logically, they sell stocks and buy bonds again. So if they sell stocks and buy bonds, what would happen to bond yields? They start going down. And when bond yields start going down and you're getting a steepening, so essentially seeing a correction in bond yields where the short-term bond yields will shoot up much faster, okay, because they overshot on the downside. And so the short-term bond yields fall much faster. The longer-term bond yields still continue to give you some kind of an interest rate till the point where the Fed actually starts cutting rates, which is usually with a lag. Because they haven't accepted that it's a recession yet. Okay, so at this point of time, it's just market is falling, so money is shifting to bonds. So when the bond market starts to rally on the back of this expectation, you're getting a steepening where the bond market is going up, yields are declining. Okay, that is a bull steepening. Okay, which is a bullish bond market causing a reversal in the yield curve, and that happens, is what happened in the last 2-3 occasions, which we are seeing here on the screen. So this was a bull steepening, this was a bull steepening, this is a bull steepening. The last probably bear steepening may have, and I need to check, may have happened only in the 70s when you again had an inflationary cycle. This is what we are seeing now. This steepening is going on at a time when bond yields are still falling. Bond yields are still rising. And the reason that is happening this time around is most probably got to do with inflation still remaining on the table. So the last two occasions, 2000, 2008, were essentially periods where you had a deflationary backdrop, right? Commodity prices had gone up, but inflation as such had not really risen to levels that were, out of control. You at the most you got 2-3% inflation, and then it went down again. Historically, inflation had been falling for 20 years in the US. And so there was no fear of inflation, and which is why the behavior of the bond market was very, very different relative to equities. That's also the reason why, 2 to 3 months ago, I was anticipating that this time around when the bond market bottoms out, and if it does so because of inflation rates falling, which is what they were doing at that point of time, equities would rally along with bonds. Now, unfortunately, that has not happened because the expectation around inflation is what is changing, that the market is thinking that this inflation is really not going away in a hurry. It's going to be sticky, and the Fed may not be able to cut rates as fast. And that means interest rates remain higher and maybe even move up a bit. And even if the Fed is not moving them up, the bond market is moving them up. But they are moving them up on the long-term yield, which is the 10-year and not the 2-year. Which in a way is partly what you would expect in form of, say, so the safety trade is still there. Okay, so how the safety trade may be working here is that people may be selling stocks, okay, and buying the short-term bonds, which is 2-year bonds, because inflation means you can't buy a long-term bond. You have the risk of the bond market falling. But at least on a 2-year bond or a short duration, like a 3-month bond, you will get paid on the yield at least in some period of time. Your bond prices will not fall, and so that is what you're seeing here. Bond prices are not falling for the 2 years, so at least people will get paid on these yields in some particular time, and they're getting paid a rate which is equivalent to the 10 years. So what the heck? So in a market where yields were falling, you would have seen even more money go into the short-term yields in the same way. But it's happening now, but it's just creating the spread, but at a time when inflation is still high, and therefore the long-term yields are falling. So this difference is causing why it is being called a bull steepening, that is a bear steepening, because the bond market is in a bear market, right? So I think inflation has caused this difference in terminology of what we are calling it. Although in the end, it is still a yield curve steepening that is happening, which is the market trying to price in an inflation risk, a recession risk, except that this time this recession risk is coming on the back of inflation and not deflation. So that's, I think, I hope you have learned a couple of things, some new terms through this discussion, and you've also got an insight as to why the reasons don't change the end outcome. That is, the steepening might still be telling us that a recession is coming, but for completely different reasons than they were in the last two occasions. Now, can it happen that at some point of time the bond market does bottom and stocks rally along with it? I'll have to really watch and see, because it's got to do with the lead lag in inflation versus equities, and there is some history that inflation doesn't peak till much after equities. At least that's what we saw in 2008 when oil prices went all the way to $135 in June of 2008. The stock market had topped out in October of 2007, and in India, Jan of 2008. So 6 months later, commodity prices were still rising, specifically oil, and it was not because of war. And so those type of things that cause the lead lag can become an unfortunate trigger for equities to decline, and that's something that now I'll have to pay attention to. Unlike before, where I was thinking, well, if inflation had really fallen off a cliff to zero, then you could have had that situation where bond yields went down and equities went up along with the bond market. But that's sort of not ended up happening, and that's why I've had to change my view on how this plays out. If something does change, I will change it. But right now, it's better to consider the alternate scenario where the two markets actually start diverging, which is bonds and stocks continue to decline. At some point, even if bonds do start bottoming out, stocks may take a little longer till inflation data really changes meaningfully. So that's all in this update. Thank you for watching, and don't forget, if you're interested in learning more concepts specifically around Elliott wave analysis and using it along with our momentum setups, trade setups, position sizing, we do a very extended mentorship program which is starting in January, and you would want to participate in that, which will involves live sessions over Zoom for 3 months and a lot more. You can find out the details. Just call the numbers below, and you'll be able to get in touch with the team and find out more about it. So that's all from me today. Thank you.